Hey traders, welcome to the Top Tier Outlook. We're kicking off the week of the Jackson Hole Symposium. That's going to be coming up this week. That's the stand-in for the FOMC meeting this month. And there are a lot of FOMC speakers on the calendar. So one of the things that I would definitely recommend, if you haven't done so yet, is check out the economic calendar, and you'll see starting tomorrow at 9:15, we've got FOMC Waller, we've got Bostic and Barr on Tuesday. Then we have the FOMC meeting minutes, as well as the Jackson Hole Symposium kicking off on Wednesday. And ultimately, what we have to remember about this Jackson Hole Symposium is it's a multi-day event. I mean, they're hanging out in Jackson Hole, good for them. But we're going to hear from Powell on Friday. So we're going to hear from a handful of members. Probably many of them will be interviewed on television. So these aren't all scheduled speeches. So just remember, it's going to be a constant bombardment of FOMC speakers. And this is pretty important because come September, you can see right there, 18. There we go. Come September 18, it is largely expected that we're going to have the first quarter point rate cut. Is it going to be the drama of, half a point cut or 3/4 of a point cut? No, but it's going to very likely be, it's 72% expectation of that quarter point cut. So hearing from the individual members before we hear from Powell on Friday, getting that consensus so that it's a unanimous vote, that there aren't a lot of dissenters, that there isn't a lot of sort of wrangling for what the monetary policy should be. Broadly expected, market participants are going to want to see that consensus. And that's a big part of what Powell's job is, to reel all that varying opinion in so there is a coordinated and concise messaging to the bond market, the index market, the currency market. This is what the plan, we agree this is what's best for the economy, and they move forward with that. Right now, this isn't a judgment on whether or not what they're doing is right or well-timed. This is just about messaging and what is expected. So that's what we've got to kick off the week. What is it macroeconomically that we're gearing up for, and what are going to be those volatility events? And likely, anytime there's a Fed member on television, anytime we have one of those events on the calendar, we've got to be aware of potential volatility. All right, that said, let's talk about volatility for a moment, because when you think about what we've been dealing with here this month, here is, there we go, August 1. And it's not as if the 1st of August was when volatility increased. That was when the weakness started to come into the market. Remember, on July 31st, we got the quarter, we moved up to about a quarter point Bank of Japan rate. So they hiked rates on July 31. So you can see already seeing some volatility on the 31st. And frankly, when looking at the S&P, we started seeing volatility, back in here on the 24th of July. Here comes non-farm payroll. So there were three big things that happened basically in succession this month. 31st, which was a Wednesday, Bank of Japan hikes again. So they hiked at the end of March. They hiked again at the end of July. Then on the first Thursday, we have some of the aftermath and weakness coming in. And then this was really the kicker. We were holding a range that was set from July 24 and just kind of going back and forth. Everything really went far more bearish on, as you can see here, as we went from the sell-off, and that was August 2. So on the 2nd of August, that was when non-farm payroll came out. And if you recall, that was a massive miss. And that's where sort of that strength of the yen was met with the weakness of the US dollar, expecting the Federal Reserve to potentially act with a lot more firepower come that September meeting. Remember, there were emergency rate cut, cries for emergency rate cuts. There were conversations of 3/4 of a point cut in. It was all sorts of hyperbole, and that type of dovish, or the kind of monetary policy that would favor, in this case, quickly lower rates, weaken the US dollar, and just made that whole yen strength all that more dramatic. And that's really what you saw here. until it wasn't. Now, what's really interesting, and I was making note of this as I was doing here we go. Nope, that's not what I wanted. I want the sectors. As I was doing the top tier outlook newsletter for the week, one of the things that was really interesting, and you can see it here, this is the month to date look at the sectors. And if you want to keep it really simple, let me just log in here really quickly. If you want to keep this really simple and straightforward, what I would do is I would draw a line, a vertical line right through, or just kind of segment out right through here. Okay, now remember, this is where all that weakness kicked in, and you can see all the weakness in the sectors on that day. Now, take a look at all the sectors that are represented here: consumer discretionary, energy, financials, healthcare, industrials. We've got real estate, home builders, consumer staples. There's a broad-based look at those most important, heavily weighted sectors in the indices. We've got regional banks for the Russell, and then of course the defensives like utilities, staples, and real estate. So everything went lower, but what's really interesting, you can see it kind of flailed around, and then on the 7th, take a look at this. This isn't just a handful of sectors moving higher. Almost everything, just like everything sold off here, almost everything to some degree is meandering higher. This is what broad-based participation looks like. So this isn't necessarily a small number of sectors driving the averages up. This is everything kind of saying, oops, sort of overreacted, and no, the Federal Reserve's not going to cut 3/4 of a point on the 18th of September. And this doesn't stop the Federal Reserve from their dovish monetary policy and, have the fundamentals and the trends of all of these sectors really catastrophically changed because of that Bank of Japan, the yen carry and the yen hedges. Did that really catastrophically affect the broader averages? And the answer is, for the most part, no. Right. And so I'm now keeping an eye on anything as we're getting towards, the latter half, winding down August, what has managed, and I actually don't want to leave financials out, what has managed to actually get above zero, actually be positive on the year. Staples, utilities, healthcare, real estate, gold miners, technology, communications, mostly telecommunications waiting within it, and financials, right? And even semiconductors are only down by about 1/10 on the year. So this is pretty promising. In other words, Rag, are you bearish? No, that's really it. I'm not. I'm just not as bullish in the things that were performing the first half of the year. So it's not a matter of whether or not there are names to buy. So much of what we've been doing in the mastery has been in those top weighted sectors. And this looks nothing like the first half of the year where semiconductors, technology were leading the charge. It looks nothing like it, right? This is a completely different relative performance lineup. And that's where a lot of traders continue to get hurt. They're sticking with the things that they like. They're sticking with the Metas and the Googles and the Nvidias, and they're sticking with names that aren't necessarily performing the way they did earlier this year, expecting them to resume, when in fact it's boring stuff like Altria and Philip Morris and Coke and Pepsi and Colgate that put the XLP atop this list. And it's energies, boring things that yield dividends like Southern Dominion, Duke, NextEra, that are putting utilities at the top of this list. One thing that is important to note is healthcare has been relatively strong compared to other heavily weighted sectors in the Dow and in the S&P. So definitely do keep an eye on sectors. All right, so that's really what we want to keep an eye on in terms of sector performance. And, when you think about why this is so important, this is watch list building 101, gang. This is absolutely how we start looking at what has the best chance of follow through, what is currently performing in a way that would suggest that not only a stock within this group, but numerous stocks within this group, meaning the group of staples or utilities or healthcare, could continue moving together. And like a school of fish, it helps if there's more than one name. So we don't want to find a single stock necessarily that's outperforming, although that could work. But the follow through is going to be so much better when that group has a rising tide, or as it's often said, a rising tide lifts all boats. All right, so let's go ahead and dive into some of the questions. That's what we're starting off the week. This is where we're going to be looking at hopefully some follow through and also that broad-based participation. S&P opening up mildly. And it's early. Remember, this is the very, very earliest look at the Asian session that will be gearing up over the course of the next 2 to 3 hours. But it's not as if we're gapping down from Friday's action. Certainly, this may not be where we are after all of Asia gets going. That's going to be around 8 to 9 p.m. Eastern. We'll see what Europe and the UK have to say about it. But right now, there's no panic on the open. We're actually moving up a little bit more. Now, one of the things that I talked about in Friday's free video over at the Simpler Trading YouTube channel, check it out if you haven't yet. Because what it is a measured look at relative performance, the macroeconomics, and the trends that we're dealing with right now. S&P and the Dow are the two most bullish sectors. NASDAQ and the Russell have both shaken off their downtrends and are a little bit more neutral. And all I'm going by here is a very easy look at the color of the top tier candle. So you'll see the last 3 candles on the NQ are yellow. The last handful of candles on the S&P are green. And you might think, Rug, why is the S&P outperforming the NASDAQ right now? Well, go back to that look at healthcare. Go back to that look at financials. Those are up near the top of what's positive this month. Neither one of those sectors benefits the NASDAQ. They both benefit the S&P and the Dow. So when you look under the hood, right, when you look at an index, lift the hood and look at what's driving it, you're not going to find the same sector weighting in the S&P and the Dow as you will the NASDAQ. All the S&P does share a lot of similar components. It can benefit from sectors like healthcare, like energy, like financials that the NASDAQ just won't be able to benefit from. So when you see where the sectors are, all of a sudden this laggy NAS makes a lot of sense. Although keep an eye on semiconductors. They're trying to shake that downtrend, and that could be something to keep an eye on this week. All right. So that is that. Let's see. Got some questions here. First up is, I was wondering if you had any suggestion on financial news. Yeah, don't. I seldom look at financial news. I don't find it, for me, Joe, I don't find it. Financial news is sort of the why. Why did this happen? Why did that happen? And it's always after the fact. Isn't that funny? The why is less, as a trader, the why is less and less concerning to me. It's the data that I'm far more interested in, and I don't need a newspaper to editorialize about the data or about the why. So I'm not a fan of financial news. That's not to say I'm not a fan of a financial calendar. That I'm a fan of. I do want to know what's going to be happening when. So I'm much more a fan of the financial calendar. So no, I don't use news at all. I mean, I only turn on the television and keep it on closed caption. For example, this week, because if there is a Fed member that suddenly is on a panel on television, whether that be Bloomberg, CNBC, whatever, it could move the market. It would be good out of the corner of my eye to see some Fed members talking about the economy, because that could increase some volatility, and it could close the distance to a level like a target or an entry or even a stop that I need to be aware of. So I don't personally find it helpful. That's not to say someone else might not, but I've done a lot of those. Got delivery of the Pink Paper and IBD and Wall Street Journal, and and they're fun to read, but I find they cloud my judgment. All right. What is my viewpoint on LMT and RTX? So my viewpoint is always going to be rooted in the data. Emmanuel, what's the trend? It's up for LMT. What's the trend? It's up for RTX. So it's buy only. Wait for some sort of pullback. And in the pullback, I'll take advantage of a buy off support. That buy off support could be a Darvis level. That buy off support could be a volatility level. I really like the volatility levels. These are sort of these, it's when I first did this, I thought I would call them kind of the code name. in the office when I was developing this about a decade ago. I used to call it a ghost pattern. And the reason I did that is because no one knew they were there. Most folks aren't looking at volatility, and they certainly are not looking at volatility in the way that it's relevant to historical zones. And so then I look at this and say, look, most people don't know these zones are there because they're not looking at the data that would provide the clarity of a volatility-based resistance level or a volatility-based support. So I'll use those quite a bit, but I think Darvis is a great way to look at it. If you're a fan of some sort of moving average-based mean reversion, those are fine. Anything that you can automate, right? So I'm not talking about trend lines. I'm not talking about, well, actually, as much as I like moving averages, I'm not talking about moving average crosses. They're unbelievably delayed, right? They're going to, by the time the moving average is crossed, depending on the length of the period, the move is oftentimes already done. So there's certain things I'm not looking at. And so for me, static levels, like the support and resistance of a Darvis, and then kind of this idea of where are these volatility exhaustion zones on a chart. That's going to be the way I would play that. All right. Let's see. What else do we have here? XLU, XLP, and XLV. Question on that. Sure. Let's jump back on over to the sectors. We'll look at a 5-day look. We're relative underperformers for 1 week. They're 1 month performers with the yen carry. I don't look for divergences. I don't actually, I know that's a very popular thing. I think divergences are really not all that helpful. So you nailed it. You answered the question, Emmanuel, and I like the way you did it. If you're looking at a 1 week relative performance, 1 week means what? It's a very short period of time. That's going to work in a very short time frame. If you're looking at a 1 month relative performance, that's going to work on a longer time horizon. That's going to work on a longer time frame. So the look back on the normalized performance is the answer. If my look back is today or 5 days, right, I'm probably looking at an intraday time frame of 1 hour or less. If I'm looking at a longer term view, maybe at this point in the month to date, quarter to date, 1 month, that's going to be a longer term time frame, typically a daily. So I don't look at it as a divergence at all. A divergence is not at all part of what I look at. However, I think you kind of phrased it perfectly by separating the look back on the performance, what performed today versus the week versus month to date versus the month, is going to give you the better time frame and time horizon. What's the difference, Rog, between time frame and time horizon? Really important difference. The time frame is, the 1 hour chart or the daily chart or the weekly chart. What is the time frame setting on your chart? Time horizon, think of that as kind of a life cycle. How long could that trend be active? How long is the expectation for continuation of whatever is happening? So that's time horizon. And so it goes to say a longer term time frame can lend itself to a longer term time horizon. All right. So let's see, what else do we have here? So what I'll be looking at as I go into, Sean, I wanted to touch on your gold question because that has been a really good sector to watch. Gold is definitely something I want to get long in. We just closed out Newmont Mining last week. The August 16 expiration is what we held for that move higher. I'm absolutely looking back into getting into Newmont Mining, Sean. I'd like to get into other GDX performers, but NEM is still probably the best. I'd like to look at GDX, but again, in a game of trade this, not that, NEM would probably win. GLD or GC also on the list, because if I'm looking at miners, it goes to say that I'm also impressed with the clarity of the commodity that would move the miner. So that same thinking is looking at copper and metals and mining, or crude oil and oil stocks, or in this case, gold and gold miners. All right, gang, thank you so much for being here for Top Tier Outlook. It shan't be a boring week. Plenty of Fed speak. We'll be hearing from Powell on Friday. There'll probably be a lot of other Fed speak that's not on the calendar because they're likely going to be on television. So just heads up. This is basically, once the Jackson Hole Symposium starts on Wednesday, this becomes the stand-in for those FOMC meeting minutes, but they'll be far more difficult because it's not as structured an event, right? They're hanging out in Jackson Hole, and whenever someone puts a mic or camera in their face, it could move the market. All right, be good to each other, gang. I'll see you tomorrow for Charts and Coffee.